Hello, I'm Nick Fenton, founder of TickerTank.com, and today I'm going to share with you my core framework for an option strategy. So there's 4 things I look for before I move further in investigating what type of strategy I may want to utilize. It has to meet this specific core framework for it to even be a candidate for a trade. Now the first one I've talked about before, but it's very important, is liquidity. So let's just review liquidity real quick. Taking a look at SPY, and let's look at the Jan 14 options with 43 days left. And you can see here the current price 178.98. So the closest strike is 179. Take a look at the 179 put side. You can see we've got 354 on the bid, 357 on the ask. That's a 3-cent bid-ask spread, very tight. Volume is 15,106. Open interest is 60,942. Minimum acceptable volume for me is about 500. Minimum acceptable open interest is about 1,000. So both of these meet that criteria. The bid-ask spread for me, I prefer 10 cents or less. So with 3-cent bid-ask spread, 2-3 cents, varying between those two, definitely is less than 10 cents or less, meets that criteria. On the call side, same story. 264 bid, 266 ask, so 2 cent wide bid-ask spread. Plenty of volume at 8,900, roughly 9,000, and plenty of open interest at 54,217, so well above that 1,000 minimum acceptable. Looking at an opposite example of an illiquid option market in an underlying, ISRG is a great example. So you can see here current price 367.70, closest strike would be 370. So let's take a look at the Jan 14 370s. We've got the put side, a bid of 1290, ask of 1350. So 60-cent bid-ask spread, much wider than our 3 cents and well above the 10-cent minimum or maximum, I should say. Now, I will make some exceptions on that in the names like Apple, Google, if they have tons of volume and open interest. But in this case, no exceptions are being made because the volume is 2 and the open interest is 177. That's awful. Over here on the call side, 1090 bid, 1160 ask. So we've got 70-cent bid-ask spread and volume of 7. Open interest of 308. Not gonna happen. So does not meet the liquidity test. Scratch it right there. But a name like SPY, or to show another example, Adobe, Google, Apple. There's quite a few that have plenty of liquidity in the underlyings. So the next thing is the preference of pre-diversified underlyings. And what I mean by that is ETFs that have a basket of stocks built into them. So SPY would be a great example. SDS is a great example. It's the ProShares Ultra Short S&P 500. But keeping things simple, DIA is another great example. QQQ, IWM, GDX, just to name a few. So these names are just underlyings that, like I said, have pre-diversification built into them, a bundle of stocks. So if some sort of new, say Apple, for example, comes out with some new, some new ground earth-shattering device, and the stock goes up 100 points. If you have naked calls in Apple for some reason, then that's going to really, really hurt you. But that move in Apple will be reflected in QQQ, its respective ETF, or its respective indice, I should say, the ETF that reflects its respective indice. It will be reflected in QQQ, but nowhere near as much magnitude. So if you were in QQQ versus Apple, that Apple news would impact you, but very, very minimally. So it's just always nice to have that pre-diversified bundle of stocks as your underlying versus an individual stock, because it eliminates some, quite a bit of risk actually. The flip side to that preference is it's very, well, not very rare, but it's somewhat uncommon that you're going to find good opportunities for a trader like me, but I prefer doing theoretically high probability of success premium selling strategies. So I need high IV percentile, and in the case of, you know, SPY, for example, or QQQ, you just rarely get high IV percentile situations in these pre-diversified ETFs, so you're forced to use individual stocks. So just keep that in the back of your mind. Next, on these duration-based strategies, and that's what we're talking about here. We're talking about duration-based strategies. I do two types of styles of trading, duration-based option strategies and earnings-based option strategies. The earnings-based are specifically based on an earnings event where I'm taking advantage of inflated implied volatility opportunity, selling that inflated implied volatility, looking for a vol crush overnight after the earnings event, and then covering the next day. But on these duration-based plays, I prefer not to have any earnings risk associated with the trade. So one way you can figure out whether there's any earnings risk associated with the trade is pretty simple. You can just go to a chart. So here we are on Adobe, for example. And you can see here in Adobe, it has earnings coming up on the 12th of December. So this would not be a good candidate for a duration-based trade right now. I would not want to enter a trade in Adobe right now because it has earnings coming up in a few days. It has earnings coming up next week. But it's something like, let's say Apple, stick with the names that everybody's familiar with. They recently had earnings come out. And let me just delete everything here to clean this chart up for you. They had their earnings event. You can just rest your mouse cursor right here on that light bulb there. It tells you the earnings came out on the 28th of October. And you can see over here on the far right, there's a little question mark right here that tells you the next earnings event is on January 21st. So you've got a little over a month and a half of duration. That's pretty eligible for a duration-based earnings play. You can put a trade in there as long as you are mindful of this earnings event impending, and you exit the trade around a week prior to the earnings event, just so you have no earnings-related price movement associated with that strategy. The question mark here just means that it's unconfirmed earnings, but this gives you a good gauge on when the next earnings is going to be. Now, if you don't see that in the corner, let's try to find one here. So okay, here we go. Yahoo, you can see the most recent earnings event here was on the 15th of October, but you don't see any question mark over here on the right. Well, you can simply go to your style, click style, and then click settings. Go over here to time axis. Currently the expansion area is 30. Let's change it to 50 and give that a try. Hit apply, and still nothing. So let's try. Yeah, there we go. It didn't apply. So we changed it to 50, and you can see here now we have the question mark showing up, telling us January 27th is the unconfirmed earnings date. That gives you a decent idea of around the time when earnings will be reported, and therefore giving you a good idea of whether or not there's a duration-based trade to be made here. You have enough to see if you have enough time before that earnings event is coming into play to actually get enough theta decay and have a nice duration-based play. So the next and final thing is your IV percentile. And here I have a custom script that tells me my IV percentile at the top left. Let me put this back on the price or the time axis. I'm just going to go to 20. There we go. Okay. For those of you that don't have this custom script, it's very simple to find the IV percentile. You simply go here on the Trade tab on your main page and go under Option Chain, look under Today's Option Statistics. So it's third from the bottom, and then you expand that. First thing it tells you is the 52-week applied volatility high. In Apple's case was 45.5. 52-week IV low in Apple's case was 21.1%, and the current IV percentile is 21%. So essentially what that's saying is the current level of implied volatility that Apple is trading at is in the 21st percentile of its 52-week range. So we can get a visual of that by going back over here to the Apple chart and going focusing down at the bottom in the implied volatility lower study. And let's just draw a channel just to kind of get a good visual. You don't have to do this every time, but I'm doing this for the sake of the tutorial here. So just kind of draw a line at the top end of its range and the bottom end of its range. So now we get a decent visual representation using the channel tool. And you can see here clearly it's near the bottom end of its range. As a premium seller, I prefer to sell options premium. I prefer being in, I focus on theoretically high probability of success strategies, which in turn means I'm a premium seller. So Apple would not be a good candidate for a premium selling trade because you want to sell premium when you have plenty of duration in the trade, so you have a nice opportunity for theta decay, but also when the IV percentile is high. So when the implied volatility is trading near the top end of its range is when it's more optimal as a premium seller like me to sell options because you're getting the theta decay, you know time's going to tick away, and you're putting yourself in a situation where it's more probable that the volatility, implied volatility, is going to decrease. And a decrease in implied volatility means a reduction in the price of the options, which benefits the option seller. In a case of Apple here, with a low IV percentile, this would be more beneficial for an options buying strategy. So another example of low implied volatility you can see here in SPY, it's trading at the bottom end of its range. It's got an IV percentile of 9, so it's at pretty much the bottom of its 52-week implied volatility range. Again, this would be more optimal for a premium buying strategy, like buying a debit spread, or buying calendars, buying diagonals, double calendars, something like that. Whereas a trade like Adobe, assuming earnings weren't coming up, like we just mentioned, you can see the IV percentile is 91 in this case. So that's very optimal for premium selling. You can see the implied volatility is at the top end of its range. It's more probable that implied volatility is going to decrease than it is going to increase. It doesn't mean implied volatility cannot increase. Just look at it from a perspective that it's more probable that it's going to decrease. So you could look at premium selling strategies like short strangles, short straddles, naked puts, naked calls, jade lizards, iron condors, things like that, where you're taking advantage of a significant, you're taking advantage of the fact that implied volatility is at the top end of its range, and you're anticipating a decrease in implied volatility as well as some theta decay. So that pretty much concludes this. Just to recap, the core framework is liquidity. You need liquid options, not just a liquid underlying. The options of that underlying need to be liquid. Diversified underlyings are preferred but not mandatory. So when you have the opportunity for something in a diversified underlying, take it. You want no earnings risk associated with the trade. So during the holding period, you want to have enough theta decay potential, time decay potential, prior to any earnings event in order to make that eligible trade. And if you don't have enough time, like in the case here of Adobe, this would not be eligible. But after this earnings event takes place on the 12th, then I could start looking at a duration-based trade. High IV percentile if you're looking at a premium selling strategy, and low IV percentile if you're looking at a premium buying strategy. So that concludes the core framework, and if you have any questions, feel free to leave it in the comment section. I'll be happy to answer as quickly as possible. Thanks.